Hi there, welcome to Kneppy Invest. A few months ago, I did a series on the 30 best performed companies on the ASX since 2013. But to draw up the list of those 30 companies, I did have a few conditions. For example, non-mining companies, companies with revenue over the past 10 years, and also only companies that have been listed since 2013. And my final condition was only companies with a markup above $1 billion at the end of May 2023. And I was thinking to myself, after I had done that series or during recording that series, why not look at those smaller companies that have performed really well over the past decade? Hence, this particular series looking at the 30 best ASX companies with a market cap of less than $1 billion as of May 31st, 2023. In this particular video, it's the honourable mentions. Those companies that did not quite make it onto the list. Also have a look at the worst performed companies on the ASX since 2013. Now, just like my previous series, I do have a few conditions, but most of these conditions are exactly the same as that previous series apart from one, and that is the first condition. Market cap below $1 billion in this particular series. Previous series, it was above $1 billion, and this is the market cap as of the 31st of May 2023. These other conditions were the same conditions I used in a previous series: revenue-making companies, zero mining companies, and also I'm looking at total returns. So share price increase or decrease plus dividends. Before we have a look at the best performing companies, honorable mention, let's have a look at the worst performed companies on the ASX for companies with a markup below $1 billion. And these are the 5 worst performers. And if you look at the 10-year analyzed total return, we're talking about analyzed returns of greater than negative 20% per year. In fact, bought long year, the worst performing company on the ASX between 2013 and 2023 had negative 54% returns per year. So you obviously did not want to be a shareholder of that company from 2013. Other bad performing companies include Retail Food Group, which was not a surprise because of the difficulties that company has gone through. MMA Offshore, and I am actually a shareholder of that company right now. And that company has turned things around, and that company is on the improve. Even though it's on the improve, still the total return, annualized return per year for that company has been negative 23.8%. Coming in fourth worst, Austin Engineering, negative 21.8% per year. And coming in fifth place, or fifth last place, is Pro Packaging at negative 19.3% per year. Now, I've also included 10-year revenue growth, 10-year EP earnings per share growth, dividend growth, gross margins, and return on invested capital. Now, I'm going to completely ignore the last 4 there and just focus on 10-year revenue growth. And you can see a correlation between revenue growth and analyzed return, a pretty good correlation there, because Port Longyear has seen their revenue decrease 57% per year over the past 10 years, fairly similar than the analyzed total return. Retail Food Group, revenue growth, negative 27, analyzed return, negative 32.9. MA Offshore, revenue growth, negative 25.6, analyzed total return, negative 23.8. So you can see a pattern here in regards to the relationship between revenue growth and total returns. In fact, I have heard one person say, an expert say, there is a really good correlation between revenue growth and outperformance of a company compared, or underperformance of a company compared to the market. So that is one of the reasons why the first thing I look at when I'm researching a company is revenue growth. Now, there's other people who say it's not revenue growth, it's free cash flow yield is the best indicator of outperformance or underperformance compared to the market. So there's many different potential factors, but research has been done on this, and revenue growth is a really good indicator of the performance and future performance of a company, not only on the ASX, but companies around the world. Now onto the honourable mentions, and I've just realised at this very second that I've misspelled honourable. I left out a U. That's the Americanized version. That's okay. I've got an excuse. I lived in America for 8 years, and sometimes I still spell words the American way. So these are companies within the honourable mentions didn't quite make it into the top 30 list. In fact, I'm including 10 companies within this section. So in a way, these are the companies that came between 40th and 31st. And the company that would have come in 40th is Bell Financial Group with a total analyzed return of 12.2% per year, which actually was a little bit more than I expected for a company coming at 40th place within this particular list. So I was pleasantly surprised. And to be honest with you, if any company that I have in my portfolio right now has a total annualized return of 12.2% over the next 10 years, I'd probably be happy with that performance. And I think stock pickers over the past 10 years probably have done really well, particularly those really good stock pickers. Because if this company came at 40th, just imagine what your total returns for your portfolio would have been if you picked the right companies, not only within this list, but also those companies with markup above $1 billion. Coming in at 39th is Ridley Corporation with an analyzed return of 12.4%. I don't know much about this company apart from they do animal nutrition solutions. Next in the honourable mentions, we have Mitchell Services. This company is all about drilling, and I was surprised to see this company on the list with an analyzed return of 13.4% per year. And then Austal, 13.9% per year. Now, I think if I did this list ending right now, Austal might not have made it onto the list because the share price has decreased significantly over the past few months, but Austal has given their shareholders a 13.9% return per year over the past 10 years. Next, in the honourable mentions, we have Prime Financial Group, and I was a little bit surprised to see this company in the list simply because of the company's current market cap, which is only about 50 million, and the very fact that this company has given their shareholders a 14.1% annualized return over the past 10 years just means the market of this company 10 years ago must have been quite small. Not surprised to see Lycopodium in these honourable mention list, 14.4% analyzed returns. And the main reason I'm not surprised to see this company in the list is because Lycopodium has performed really well over the past about 2 to 3 years. And the market cap of Lycopodium right now is around about, say, 350 to 400 million. The next two companies in the honourable mentions, we have Infomedia, a company with a market cap above $500 million. That company has given their shareholders a return of 14.5% per year. And that company I am doing a little bit more research on, Cog Financial Services, does seem like there could be some value with that company, even though I think there might be some value with that company. And even though the share price is in a downtrend, the company has given their shareholders a 14.6% return per year over the past 10 years. And the last two companies that are in the honourable mentions, two companies that just missed it, making on the top 30 perform companies with a market cap below $1 billion, are Brisbane Broncos, which, yes, you can buy the Brisbane Broncos on the ASX. Now, personally, I would never take a position in this particular company because if I were to buy a sporting team, I would have to have complete control over that team, which means 100% ownership. And to be honest with you, more than likely, I will never have the money to take complete ownership of a sporting team. I think it's more of a hobby. That's the way I would look at, and that means I'd have to be filthy rich to buy a sporting team. And just missing out, making it in the top 30, is Emundi Group. I'm not sure how to pronounce it. And to be honest with you, I know nothing about this company. Now, Emundi Group, 16% returns for the shareholders over the past 10 years. Current market cap of this company is only $54 million. Had a quick look at what they do. This is according to Market Index. Emundi Group is involved in the operation of the Ashmore and Aspley Central Taverns and the holding of investment properties. Now to something surprising that I did find when I did some analysis between that list of companies that performed best over the past 10 years with a market above $1 billion compared to this particular list. What I expected to find wasn't what I actually found. In fact, it was a little bit surprising what I found, and maybe I am being a little bit naive because I fully expected the list of companies with a market cap above $1 billion to outperform the list of companies with a market below $1 billion. For example, if you took a company that came in 15th on both lists, the company with a market cap above $1 billion would have had a better analyzed return than that company that came in number 15th on this particular list of companies with a market cap below $1 billion. And that's not exactly true. It's not always a case that the bigger company performed better than the smaller company. And for example, I've taken the 30th best performed company in each list. Now, James Hardie came in at number 30th in the companies with a market cap above $1 billion. And that company had an analyzed return of 17.3%. And if you compare that return to the company that came in number 30th in this particular list, which I've not named just yet, I'll reveal that company when I do the next video, that company had a return of 16.5% per year. And this sort of similarity between the returns I found consistent throughout both lists. And I think the reason why that surprised me is because my thinking has been distorted by Pro Medicus. That company went from a market cap below $100 million in 2013 to a market cap above $6 billion, maybe even $7 billion in 2023. And I thought that scenario would play out time and time again on the ASX, not quite to the extreme of Pro Medicus. But that's not exactly true. There are still a lot of really good performing companies on the ASX with a market below $1 billion. In fact, I fully expect quite a few companies on this particular list with a market below $1 billion to eventually see their valuation climb above $1 billion and beyond over the next few years. And that's why this particular list and revealing companies in this particular list is quite exciting, because which companies are going to make it big in the next 5 to 10 years. So that's all I have for this honorable mentions of the 30 best small cap companies on the ASX with a market below $1 billion since 2013. If you have any thoughts about the 10 honorable mentions I mentioned in this particular videos, or the 5 worst performed companies on the ASX since 2013, small cap companies less than $1 billion, I'd love to hear your opinion on any company I've mentioned in this list. And what do you think will come number 1 in this list? And to be honest with you, it surprised me to heck what came in number 1. I did not expect it. And to be honest with you, I've done zero research on this company. And maybe that has been a mistake, because it is one of the best performing companies on the ASX over the past 10 years. But you have to wait another about 5 videos or so before I reveal that particular company. So that's all I got for this video. And don't forget, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.